A very warm welcome to IDFC FIRST Bank presents Leaders of Tomorrow Season 11. I'm Ritwka Gupta and you're watching highlights of our recently concluded Dehradun Springboard. Yes, I'm in this beautiful city of Dehradun where we are decoding the opportunities and trends in Dehradun's thriving startup ecosystem. In the first segment, we'll have a keynote presentation by Chaitanya Suvanam, Managing Partner, Startup Banking, IDFC FIRST Bank. And in the second segment, as part of our Welfare Special, we are speaking to Verendra Kalra, Managing Partner, Verendra Kalra Co.
Nestled in the heart of Uttarakhand, Dehradun's tranquil pace is witnessing a roaring revolution. Today, the city is unlocking possibilities where innovation and an indomitable spirit are the growth drivers for success.
Thanks ET Now team for bringing all great entrepreneurs. Once again, doing this across India, 20 cities is really an amazing job. You're in a way you're really creating an ecosystem of entrepreneurship and leadership across India. Thanks for it. And IDFC FIRST Bank is always proud and happy to be associated with Leaders of Tomorrow event. So I just was thinking, what comes to anyone's mind when you think of startups? Any guesses? Of course, a few of the things that I have on top of my mind when I was thinking of startups of any place. Of course, you will be thinking about startups typically innovating, right? So what do startups do? They see a sector and then they see how the sector is currently and then how they can bring in new technology and really disrupt that segment, how they can innovate and change the status quo. And if they build and then they try to grow fast. And startups, typically when things don't pan out the way you think should pan out, typically startups pivot. And what else? Leveraging technology, all these things. So, and then when I was reflecting IDFC's journey, I somehow felt like probably all of these are applicable to IDFC as well. So I will just take you through how IDFC started. IDFC got IDFC Bank that got license in 2015, and by 2018, IDFC Bank was predominantly a corporate banking bank with about close to 80% of the balance sheet being corporate banking. And then the board and the investors thought it's time to pivot because they saw a great opportunity in retail segment. And that's when they asked the bank and that time an NBFC, which is really pioneering in consumer finance, which is capital first, to merge and pivot the bank. So that's when the new management has taken over in 2018 and 2019 early. So that's the pivot. We want to really foster SMEs, MSMEs, and individuals. Again, we want to be close to the individuals and SMEs and MSMEs. So even the deposit base has shifted towards that. IDFC Bank realizes the importance of pivot and how entrepreneurs feel towards this journey, right? And so this is last quarter's balance sheet. You can see how it has helped us grow about 1.7 lakh crore, and all the metrics are there for you to see. But the essence of this is the pivot has worked well. So as a bank that has successfully pivoted, hopefully we understand what you guys go through as entrepreneurs when you have to change your business model. So how did we achieve this? 2018 when we pivoted. We looked at the banking landscape. We saw lots of chances to disrupt. The first thing, of course, is so all of you have current accounts, right? As entrepreneurs, everyone has one, and all of you leave some money in the current account for day-to-day business activities. And you would love if that surplus money can earn interest, right? But traditionally, banking thrives on car balances. That's how banks get deposits. We thought, okay, that's good for us, but what about the entrepreneur? At an early stage, especially, we believe that every rupee matters. So let's think of the customer first. Let's put what is in their interest. So we launched something called the Car Booster account. So it's a it's a simple product where your current account balances will be swept into an FD, and whenever you need them, if you give an RTGS request or a check, and those FDs will be broken in the in the denomination of even 1 rupee. So if you need 99 rupees, exactly 99 rupees will be broken, and the rest will continue to earn FD interest. So, which is a big disruption in in banking segment. And then now we see most of the other banks are following us. Again, we were analyzing. I will give you a couple of examples of how we look at this space and how we put the customer first and try to disrupt this banking segment. Again, any of you, how many of you have credit cards here? Your personal credit cards? Okay, quite a few of us, almost all of us, even if you have not raised hands. If you have ever missed, paying the interest on or paying the balances on time, it's a sin, right? The banks typically charge about 35 to 40% interest on credit cards. If what we call a revolve. Again, when we looked at this space, why is it so? If you take a personal loan, which is again just a loan against your name, you will be charged typically 9%, 10%, whatever is the is a personal loan interest rate as per your credit bureau score. So we thought it should be that, right? A credit card outstanding should be a simple personal loan. So what we did was we launched our credit cards linked to your CIBIL score. So if ever you have an IDFC credit card and you miss for whatever reasons to pay the the amount on time, the due amounts, it will simply pull your credit score and see what is the interest chargeable according to your credit score and convert it to the interest will be charged as per your credit score. It can be 9%, 10%. It starts with 9%. Again, a big disruption. We see other banks are following this. So the point is, we try to put the customers first and see what is good for the customers and what makes sense for the customers, and try to disrupt banking space. So this is all product innovation. This is great. Of course, products can be made, many products can be made, but products can only take a bank only so far, right? What is really defining this era, I would say 21st century, is technology. So we have to back it up with technology. And as IDFC FIRST Bank, luckily we don't have legacy technologies with us, so we are in a great position to bring really cutting edge technologies. So if you see last few years, any disruption in technology, be it on the UPI side, NPCI has launched UPI for foreigners. Till now, only Indians can use UPI, and soon foreign travelers into India can use UPI. If NPCI has started the phase 1 with IDFC FIRST Bank. ONDC, again, the way UPI has changed the face of payments in India, and we should all be proud of it. ONDC hopefully will change how e-commerce happens across India and across the world. Hope other countries will soon follow ONDC example. Again, one of the few banks who open ONDC accounts and who give end-to-end technology for your ONDC accounts. I can see, some of the D2C companies in the audience. You want to put yourself on ONDC and reach global audience, we are there for you. We can provide you the platform to quickly get onto ONDC and sell to international customers. This is the startup story, guys. Everyone here is really proud of how startups are thriving in India. We are the 3rd largest startup ecosystem. 109 unicorns and hundreds more sunicorns. All this is fine. When we looked at it, somehow for some weird reason, all banks seems to be focusing only on metros. When they serve startups, they seem to be focusing on metros. But in our nerve, we understood the next generation of unicorns will come from non-metros. I'm sure when these 109 unicorns grow to 218, fair share of next 109 unicorns will surely come from places like Dehradun, places like Guwahati, places like Shillong, places like Kanpur, Varanasi. We go to many universities and see bright entrepreneurs disrupting their respective spaces. So, we thought, let us reach to these places, So we have startup banking teams, much more than metros, we have startup banking teams in non-metros. That, again, is a very, innovative way of thinking about startups, I guess. And today, as I speak, we have about close to 750 startups pioneering in their respective segments from Uttarakhand. So we want to serve these startups. So How do we do it? Very simple. We thought, let's focus on early stage and growth stage. Let's continue our philosophy of keeping the customer first and trying to create products for these customers according to their needs, not according to the bank needs. So we believe that next 109 entrepreneurs, 109 unicorns will come from places like this, Dehradun, or brilliant places where entrepreneurs are innovating. And we would like to help them in every way possible and see that happen. And all the best for your journeys. Thank you so much.
It's time for a quick break here. We'll be back shortly. Stay tuned. Welcome back to IDFC FIRST Bank Presents Leaders of Tomorrow Season 11. You're watching highlights of our recently concluded Dehradun Springboard. In this segment, we are talking all things money with Verendra Kalra, Managing Partner, Verendra Kalra Co. Listen in. Thank you so much, Mr. Kalra, for joining us today on Leaders of Tomorrow, Dehradun Springboard. As you know, this is our Wealth First segment where we talk all things money. So I actually want to kick off this discussion since we have a lot of entrepreneurs, in our audience, to really, for you to explain to us the importance of, maintaining a clear and detailed financial plan for entrepreneurs. If you can just take us through that as way of opening comments.
So I think, what I've seen with most of the startups I've been helping. So I've been in practice for 35 years as a chartered accountant. And now I think because the startup phenomenon is something new, which has been there for the last 5-7 years. But what I've observed with people who have come to me for assistance, what I've seen is, that most of them are tech guys or they know what they are doing, but they absolutely have zero idea about finance, right? And this is where the biggest problem lies. Because when these people come, they don't even know how to make a sort of a plan, even on an Excel sheet. They have zero skills on Excel. They have zero skills on numbers. They obviously have skills on what they want to do and what the passion lies with. So I think this is where we need to guide them and first put the figures on a sheet and say, what is going to be my turnover? What is going to be my cost? What are going to be my profits? That is something you have to put down on the number sheet. I can tell you, people just walk in and they say, we are confident we are going to do well, but they don't have a plan. Now, this is where I think they need assistance. And this is where you need somebody to guide them at the initial stage. That they can do. Probably they can go to a good consultant. But the problem with startups, biggest problem with startups, which I feel is that they don't have that kind of funds to go to a good consultant. Right. And that's a very big bottleneck. And probably people do skip that part of the whole story because they believe they don't have the funds to spend on that part. But that is the most important part. So I think the first thing is you have to put down in black and white, what are you going to achieve? And the first year, what's your milestones? First, you obviously have to see what are your margins on what you're doing. What are your margins in terms of how you're going to land up with your numbers, in terms of your expenses. You have to list down your expenses. You have to know what your expenses are going to be on a monthly basis. And finally, what is going to happen in the second year? What is going to happen in the third year? At least as simple as that. I'm not talking something very complicated as far as my profession is concerned. But something as basic as making a layout where you're putting the numbers on a yearly basis and then actually doing a reality check on it. So I think people need to start with that. That's the first very, very important thing which most of them fail to do.
Right. Mr. Kalra, just backtracking a little bit, tell us what are some of the key financial challenges that entrepreneurs, are likely to face when they are just starting up? And if you could also demystify for us, some of the myths, when it comes to really wealth management and, for entrepreneurs, what can you tell us?
So I think the biggest challenge is this: one needs to understand, one needs to learn how to sort of come up with a marketing pricing strategy, and then. Looking at that, I think funding, we are talking about that part of it. And then maybe understanding that how much is your burn rate, what are you going to be expenses to scale up, and then how are you going to survive on that for how long. Yeah. And we definitely don't want, I'm also of that school that where I'm going to say that we don't want funding initially. As long as we can sustain it, we'll try to sustain it. But how do you sustain it? Whether you have that kind of pool of funds to sustain it in the first 3 years, 4 years, you have to do those calculations in a financial plan and then come up with that.
Right. I know I'm just picking up from what you said, and given our previous discussion as well, having a startup is like, you have to take a risk and you have to sort of balance a lot, in terms of your cash flow management as well. So what would be your advice to some of these startup founders, right, who are looking at financial stability, but at the same time, they also want growth? How can they balance?
Financial stability and growth. You see, I think that for an early stage startup, they are little alien words because, you see, obviously business means risk. That's the whole problem. When you're talking about stability, you are actually entering and taking a risk into something which you've not done before, which you're trying to accomplish. So I think this is where the lifeline is. When we are talking about finance, I think this is where the role comes in. Because once you have this guidance from the numbers before you, but what you need to do, when you drop the numbers, you have to see the numbers have to be realistic. There has to be a reality check on the numbers, right? So, as a core finance professional, I would say, please do your numbers well. Don't be overconfident on your numbers. Most of the people go wrong when they are a little overconfident on the numbers. They believe something which they start believing themselves, but which might not actually turn out to be true. The first thing you need to do is ensure you are not going to overspend. You have to control your expenses from the first day itself, right? And that also becomes an issue when you're getting funding. Because most of the people go wrong is that when they get that kind of funding, they start spending. And that spending is because you believe that that spending is coming from somebody else's money. Or some, it's been easy. Probably you got some easy investor who walked in and he gave you the funds. But you can't afford to spend that money. That is your money, ultimately. And this is where you have to control it. So I think stability point of view, maintain a very tight cash expense line. When you're controlling your expenses, and then you're trying to maintain that buffer as long as possible. So whatever funds you've raised, whether you're bootstrapped, whether you have come through your own funds, whether you've taken funds from your friends and relatives, till the time you don't have really sold or diluted your equity, you would like to maintain that buffer as long as possible, and then try to achieve or demonstrate a certain level of achievement with those funds so that when you pitch, you can pitch at a higher valuation, you can reach out to the investor when the right stage is there, when you are mature enough to actually reach out and drive a better bargain from the investor. Because in the initial years, it's going to be you're going to get slaughtered. When you go to an investor, they're going to buy you cheap and you will sell out cheap. But the guys who hold up, who are going to manage this stage with those funds, and then that scalability comes. It doesn't come up initially.
Right, and just again picking up from what you mentioned, and this was a question I asked in my earlier discussion as well, but I want to know your perspective as the financial expert here. So what advice would you have for entrepreneurs, who are seeking funding then? How do they approach an investor? What sort of plan should they have? What can you say?
The investors don't look at just balance sheets. They are looking at much more. They are looking at, I think the first thing is, of course, the idea. Whether that idea, has a model behind it, where that idea has a financial model behind that idea. So if you have a good financial model, I think that's the first thing the investor will look at. Second thing they would look at is the team. If you have the right team, and whether that team has been allocated responsibilities among all the people. Sure. So within your team, you have experts who can handle finance. You have experts who can handle the product side of it, who can handle the marketing side of it. They're going to look at that. Third thing they're going to see is the passion, right? So these are not financial things, let me tell you, right? But an investor would just not, you can't entice an investor saying that I have a rosy balance sheet, therefore you can, give me funds. So it never works out like that.
So I want to also talk a little bit about tax planning, which is a very important aspect of financial management. What are some of the tax saving strategies would you have for entrepreneurs? What can you share in terms of how they can best navigate the taxation bit?
So I think when you are looking at a business model perspective, when you are talking about a tax saving strategy from a business model perspective, The first thing which is important is you have to see the margin of your products. So any investor would be very happy to join and latch on to a startup which has good margins. Now your good margins are derived from the gross margins. Now if your product is selling at a good gross margin, then definitely I think that seems to be a better business model as far as any investor is concerned, right? And that of course has to be sustainable in the long run. You know, whether you have that advantage, why you have that advantage is the business model behind it. Why you're going to sustain those large gross margins is something which the investor will work on. As far as a tax advisor, I would say try to use all the incentives which are available to you, which probably this environment offers today, right? With all this DPIIT support coming in, the state government support coming in, there are a lot of policies which actually are giving you some incentives. Try to use every possible incentive when you start your startup, or probably pitch a startup where you have the largest incentives coming in.
Thank you, Mr. Kalra, for your time. This was almost like a personal consultation, but thank you so much. I think our audience will have a lot to take away. Thank you once again.
Thank you, Ritwka. Thank you so much. Yeah, thank you.
And with that, it's a wrap on this edition of IDFC FIRST Bank Presents Leaders of Tomorrow Season 11. We hope you enjoyed the conversation. Stay tuned for part 2 tomorrow. Thank you for watching. Goodbye.